This video is going to be a use case study on Splitit payments, the stock code SPT. Now, earlier in the year, it did a meteoric rise from 30 cents to $2. We're going to look at two key things, and there's going to be two key takeaways. One of them is going to be how to read the financial report. So following on from stock tip number 1 on how to read the 4C/quarterly. And the second component is looking at market hype and how fundamentals don't necessarily need to line up for a stock to run. So let's have a quick look at the kind of reports that have come out right as the stock opened. So right on the day of IPO, business operations update. We open this one up. We can see there's going to be some highlights, and of course, I would consider this type of document to basically be a bit of a propaganda piece, right? It's, look at us, we're so great. So if we scroll down, we can see, look, these guys, they've been growing the amount of merchants, the amount of unique shoppers has increased. Everything looks healthy and positive, right? So all these stats are just growing and growing. And of course, with an IPO, with a new company, you kind of want a growth story. That's the kind of story you're going to sell people, is look at us, we're just exponentially growing. And of course, you got these nice little charts here, predictions of merchants and value, yada, yada, yada. So that's all well and good. But when we actually dig into the numbers, when we look at the quarterly statements, we'll have a look at that and see what it shows. So let's find what we need in the quarterly documentation. Now this, because it's an IPO, is located in the prospectus. So if we open it up, it's actually quite a detailed document. It goes on for pages and pages, 166 pages actually. So it's quite lengthy. You just need to really cut through the fat and locate the financial information. So here we are, and we can find the revenue from the operations that they were doing up until 30th of June 2018, and that's sort of the latest financial figures that they have. I don't see anywhere any updated figures for 2019, but this is what we can see. We can see the revenues were 272,000 and the cost of revenues is 144. So really their gross profit was $127,000. Fine. Then we can see research and development, $500,000 almost, marketing, almost $500,000 again, and admin costs. So I guess the people running the business, $700K. So we can see it's actually a relatively expensive business to run compared to the amount of revenue they bring in. And keep in mind, this number's just revenue. Your profit's only $127,000 for the business. So if we scroll up, we can see just how much cash the business actually has. So they've got $215,000 in the bank as of 30th of June. They have $1.5 million worth of total assets. And they've got a debt of $10 million. So this is their liabilities. So you take the current liabilities away from the total assets, and that's how much you end up with, negative $10 million. So when it listed on the ASX, they had a financial position of negative $10 million. So after looking at the financial data, we want to head back over to the prospectus. We want to understand what the market capitalization is for the business. It's all well and good that we understand that the financial data shows us it's got $10 million debt, got $1.5 million operating costs every year, and 127K profit every year. But those aren't quarterly numbers, those are yearly numbers. So that doesn't mean much unless we understand what the market cap is. So if we have a $5 million company, then you'd be going, look, there's some upside to this business. But if it was a $200 million market cap business, you'd be going, really, it's a bit much. So we look over here in the key offer statistics in the prospectus, and we can see they're offering shares at 20 cents, and they're issuing about 60 million at the high end, at the maximum end. So they're going to raise $12 million. That's what it's going to give them. Now, keep in mind, the number of shares isn't going to be 60 million. It's going to be 260 or close to 260. That's because there are shares that already exist prior to the IPO, and that's super important to know. If this was a $12 million stock, you'd be going, yeah, that's actually not bad, right? The financial numbers aren't great, but it's a growing business, there's a growth story, yada, yada, yada. But there's some upside to it. But what we're seeing here is it actually opens up at $54 million market cap, which to me sounds a little expensive. So if we look at the stock price movement, we can see it IPO'd at 30 cents and moved all the way up to $1 in the space of just under 2 weeks. So it IPO'd 50% higher because the issue price was 20 cents. It IPO'd at 30 and moved up to $1. So if we look at the market cap, it was 260 million shares multiplied by, well, $1. So it was $260 million when it hit $1, and then it just moved back down a little bit over time, and then it had another run up to $2. So at $2, it was $520 million. That's $500 million for a stock that IPO'd with $10 million debt, cost $1.5 million to run, and had $127,000 of profit. So they were running at roughly $1.4 million loss per year. And of course they raised $12 million, so I guess you can negate the fact that they had a $10 million debt. But we've still got a business that's running at a loss that really doesn't have a whole lot behind it. And it's at $520 million market cap. Like, that doesn't make sense. Of course, when you look at the financials and the fundamentals behind it, ignoring the fact that it's got a growth story behind it, because the growth story isn't significant enough to have a $500 million company. The growth here, there is no amount of growth that'll make this stock $500 million. It is insane. So let's have a look at actually what caused it and why the fundamentals didn't matter. I would argue that APT, or Afterpay, is single-handedly responsible for the rise of SPT. Now, SPT and APT, they work in a similar credit space. They both work in credit, but not being a bank, right? They work in the same sort of sector and environment. So if we have a look at APT's price action, we can see that it's actually multi-bagged several times over, and it created a really bullish sector. Now, being a new hype sort of sector that APT started, one would look at SPT and go, well, they're in the same sort of environment and space, and people are saying that APT was a loss-making business as well, so why shouldn't SPT follow the same footsteps as APT? Because look, APT is successful. Well, let's have a look at the financial report. This report actually came out a few days before the IPO of SPT. So we open up this document and we go down to the financial section. And mind you, this is for the end of 2018. So this document would have come out right before the IPO was listed on the ASX for Splitit payments. So we can see a healthy position of $112 million of revenue and $86 million of that's profit. And after operating expenses and after taxes, we end up with a $22 million loss. And keep in mind, the previous year, it was less than $1 million loss. So people would look at this and they go, right, well, Afterpay is super successful. It's in the billions of dollars for the market cap. Why should SPT not be successful as well? I mean, they're running at a loss. Well, this doesn't tell the full story. That doesn't mean a whole lot on its own. We've got a real big growth story here. So we scroll down and we look at the assets and liabilities. We've got $600 million worth of assets for Afterpay. That is enormous. And you're probably wondering, right, well, assets don't mean much unless you look at the liabilities. Well, fair enough. We've got total assets of $600 million. We've got current liabilities that equates to $245 million. And that gives us a total equity of $340 million. So we have a business that if we just shut down everything today, everything they have is worth $340 million. That's an overly simplistic way to look at it. But when we look at the equity from the previous year, it's doubled in equity. Sure, we've increased our losses a little bit, but the value of the business has gone up significantly. So when people want to compare two businesses together, you got to look at apples to apples. You can't just pick apart certain parts of the financial document. You got to look at the equity. You got to look at the value of the business. You got to look at profits. You got to look at assets. You got to look at liabilities. You got to look at everything as a whole. So when people say, or rather when people did say that Afterpay and Splitit payments should be on the same upward trajectory, it's just a recipe for disaster. People oversimplify things by looking at simply the profit and that's it. And there's your story. Unfortunately, it's not the case. And look, this is the result of oversimplification. You know, you've got two businesses, one that's worth hundreds of millions of dollars and is becoming a household name, and then you've got a new IPO stock, which is running in the same sector, also running at a loss, and one can conclude that, hey, investors and traders might be comfortable with a loss-making business, therefore there's no reason that this stock shouldn't also be pumping to the upside. The reality is that this stock moved on hype and purely hype alone. Looking at the financials, one wouldn't conclude that this was a $2 stock at any given point in time. Absolutely not. At no point in time did someone look at the financial documentation of Splitit payments and go, this is a $500 million stock. It's just not reality. So this drives home the point I've been making in my previous tip videos, that in the small cap and micro cap space, you're trading a story, right? You're buying into something and you're saying, hey, look, SPT is going to be the next Afterpay, and Afterpay is worth billions of dollars. So that's the story you're selling. It is super simple. It's a really simple story, right? And realistically, that's what you're doing in this small cap, micro cap space, is you're selling a story. Now, I don't want the takeaway piece of information to be that it's not worth reading financial documents. It certainly is. It's just in this use case, in this specific case, hype and momentum and the story that drove Splitit payments was far, far more impactful than any financial pieces of information. I was looking at forums and reading the justification of what people were saying. They were saying that it's a growth story, it's a growth stock, it's in the same sector, therefore it's going to be, it's going to make us rich. And this is the story that people bought into, and this is the story that people believed. So of course, people were buying into it. And that's basically the drive and hype. Like I mentioned in all my previous tip videos, you want to buy the story and then you want to sell the story. In the small cap and micro cap space, the story is what you're trading. If you want to trade the financial growth, if you want to trade the profits of a stock, then trade it in the mid cap space, a company that's been around for at least a couple years. It's got a nice trajectory, it's got a nice predictable trading pattern. That's when you want to read the financial documentation. When it comes to the micro cap and small cap space, you want to read the financial information to understand what a business could be worth. And in this case, I still think it's worth about 15 to 20 cents, this stock. You want to read that financial documentation to understand if any capital raising is coming. That's the sort of key component that you want to understand for the financial docs. So we can see here, the market did correct itself and come back down and use some sort of common sense and rationality. It's taken several months, but it eventually got there.